Hi, John Dobis from Forbes here at the San Francisco Money Show. I'm talking with Tom Grimes of Reeves Asset Management, located in the same town that Forbes is based in, Jersey City, New Jersey, baby. All right.
Great to be here, John.
Hey, Jersey. So you've got a great niche of the market. You are a manager of funds that invest primarily, some exclusively, right, in utility stocks.
That's correct.
Now tell me how you can possibly get an edge. You know, there's the XLU out there that you invests in a broad basket of these regulated utilities, but you guys have had a track record over the past dozen years or so, right, that's done better than the XLU. How do you, give me the special sauce, brother.
Give you a brief history.
Yeah.
Our founder, Bill Reeves, came out of the public utility space as an analyst at Kidder Peabody all the way back in 1961. So that's in our DNA, following utility stocks. Started managing money on behalf of institutions in 1978. Added oil stocks and telephone stocks to that mix, and we've built a very strong low double-digit return net of fees track record over the last 40 years. 13 years ago, we launched a closed-end fund, the Reeves Utility Income Fund, ticker symbols UTG. It's done very well. It's has a total return of over 12% a year over the last 13 years.
That'll get you somewhere.
Yeah, primarily utility stocks. Also has a few oil stocks and communication stocks. We like the cable TV space. The real focus for us is finding companies that are well managed, that have commitments to dividends and raising the dividends so we can compound value over a long period of time. And specifically in the utility space, we like good regulatory environments combined with good demographics. So Florida has been an area of the country, obviously, with
growing population, right?
Americans retiring and wanting to move to a state with good tax regulations, as well as a nice climate for older folks. The local utilities there have done very well. Regulators have been very supportive. And John, if you think about it, regulators should be partners of the utilities. Yes, they have to make sure rates don't get out of control, but they want a system, a grid that has integrity, that holds up well when there's storms, that's reliable. Today you have to worry about cyber terrorism and people trying to take down the grid.
So you want to have the utilities make enough profit to reinvest it into the stuff that works.
And the companies that have good relationships with their regulators, the regulators will let them spend money. Also environmental. We want to have less coal, more solar, more wind, more natural gas plants, so we take down the level of emissions. And that is very much, companies are being incented to spend that money, and when utilities spend money, they can earn a return on it, and they've been able to keep rates very low during this period. So it's been a great environment for utilities investors. The last 8.5 years, the S&P 500 Utilities Index is up almost 14% a year.
It's been a great thing with interest rates going lower, of course.
The market. The rate environment has been very stable. We always get the question, Tom, what's going to happen when rates go higher? You know, should I sell all my utility stocks? And I say, you know, at the depths of the financial crisis, the 10-year bottomed at 2.07%. And today, we're at 2.17%. In 8.5 years,
right, and the XLU or utilities,
1.5 to 3. We haven't had much movement in interest rates, so we don't see rising rates as much of a problem. If they were to start creeping up, we think we own good companies that could raise the dividend and stay ahead of them.
I know in the short term, you've got a pretty tight correlation though between like the 10-year Treasury yield and the price of equities in this space. So, but you're saying over the long term, if the dividend growth exceeds economic growth or inflation, you're going to be okay?
Yes, that's the key. And the key is, you said short term.
Yeah.
Utilities investors tend to get spooked when you have that first move in interest rates.
Well, look at the past year, right? I mean, after the Brexit vote, people thought the world's going to fall apart, I guess. I don't know, but bond yields were down like 1.3 in the 10-year, and then climbed. They've been climbing ever since, more or less.
We launched an ETF focused just in the utility space just about 2 years ago, September of 2015. The utility stocks had taken a dip. There was a lot of fear that the Fed was going to start raising, and indeed they did in December of 2015.
A little bit, right? Yeah.
They've raised again since. And our ETF is up over 40% on a cumulative basis in our first 2 years, and we have outperformed the index and the other ETFs that passively track the indices.
Well, this guy's got an electric track record.
Very good.
Thanks a lot for being here, Tom.
Yeah, thanks, John. Appreciate it.